I would say that 1980 was a true monetary panic. And in monetary panics, the top derivative layers of the pyramid fall the fastest. This is the S&P adjusted ounce 1980 target is $3,006.
What happens when confidence in money itself collapses? Most people have never lived through a true monetary panic, but history shows us that when it hits, entire financial systems flip upside down in weeks, sometimes days. In 1980, silver rocketed to levels that seemed impossible, breaking through every barrier and stunning investors. And according to Rafi Faber, we're facing another one of those moments, an endgame where credit evaporates, stocks implode, and real money explodes in value. Not in some distant future, but in our time. So, how high could silver really go? Faber lays out $7 targets for the endgame, ranging from $118 an ounce to over $3,000. These aren't random numbers. They're tied to real ratios: commodities, inflation, gold, and the collapse of stock markets. And the logic is chilling.
But silver crossed $40, and I believe it is now at $41.60 over the weekend, Labor Day weekend, and everyone is really excited, at least everyone who follows silver. What I'm going to do today is give you $7 targets, 7 end game dollar figure targets for the silver price, ranging all the way from $118 all the way up to $3,002, and I'll explain why each of them makes sense. Well, then you can tell me if it goes anywhere from 118 to 3002, how does that make sense? Well, the answer is that the dollar figure doesn't really matter that much. What matters is how much purchasing power moves into silver and gold ounces in the end game. And the ultimate answer to that question is on the collapse of credit, as I explain at the Endgame Investor on Substack, and you can get the full explanation there. On the collapse of global credit, all the purchasing power moves into credit, which is no longer trusted, which includes dollars, bonds, stocks, and all that other stuff, into money itself. So the answer is that all the silver now accessible by people above ground will be exchangeable for all of the wealth on the planet. What that dollar figure exchange rate is could be anywhere from $118 to $3,002 based on today's monetary metrics, which change daily. But let's get into it. The 7 targets for the silver price, starting with the CRB adjusted ounce target of $118. CRB adjusted means we're going to take the silver ratio to the CRB commodity index, its lows, meaning how many ounces of silver did it cost to buy one basket of CRB commodities. The CRB commodity index is an index that's been around since the 1970s, I believe, or even earlier. I think it was interpolated earlier, but it started to get use in the 70s. The low for this ratio means the least amount of silver ounces that a CRB commodity basket was worth was, of course, in 1980 at about 8 ounces. Well, you see here where it says last 20.22. So if we go down to 7 or 8 and then we multiply that factor by the current silver price of $41, we get $118 per ounce of silver. But this is the lowest dollar amount target. I believe we're going to get much higher than that. We're going to go to the next one, which is this CPI adjusted ounce target. If you adjust for CPI, a lot of people are fans of this one. I'm not a particularly big fan of this ratio because the CPI itself is adjusted and manipulated and doesn't make much sense and is very subjective because people buy different things. But anyway, the high here for 1980 relative to the CPI going back to 1800, or interpolated back then, which is all an estimate because nobody knows exactly what the prices really were back then. But anyway, the high was $172.54 CPI adjusted silver ounces in 1980. But that target I don't really like, and I don't think it's realistic. I think it's way too low. The Dow Jones Industrial Adjusted Ounce 2011 target for silver. So we're going to take the Dow Jones ratio to silver back at the 2011 high. This is not the 1980 high. That's a separate chart. We're going to get to that in a minute. The 2011 high was at about 250 ounces of silver for one Dow Jones Industrial unit. And we are at 1146. You can see here, this is the first bubble of stocks, major bubble relative to silver, peaked in 2001. This is the second bubble. It's been wobbly since about 2017 or 2018 top over here. And we've been heading down since then in jagged little edges. But I think this bubble has peaked in 2017 or 2018, whenever that peak happened to be. If you take the 2011 top in silver ounces, 250 ounces per Dow Jones Industrial Average unit, 1146 to 250, take that ratio, multiply it by 41, and you get a target of $188 for the 2011 silver high relative to the Dow Jones. This is much more realistic, but let's keep going higher. The gold adjusted ounce target is $236. If we're talking about the 1980 high of gold to silver ratio of 15 to 1, which I go into on this channel often, in the end game, we are going to see something around a 15 to 1 ratio of gold to silver. This is the natural monetary ratio. It will reintroduce itself. We saw it in 1919, we saw it in 1968, and we saw it in 1980, and we are going to see it again. Now, if we reach the 15 to 1 gold to silver ratio, which we will at the current gold price of about $35.50 over the weekend, that leads us to about a $236 target for silver if the gold dollar ratio doesn't move, which of course it will. So this is just an idea. It's not an exact target pick. But let's move even higher, shall we? The S&P 500 adjusted ounce for the 2011 silver top is at $265. Why is that? Well, I drew the red line here for the 2011 bottom. We're estimating it's at about 25, just eyeballing it over here. I didn't do the exact numbers, nor do they matter that much because this is all an estimate anyway. Here again is bubble 1 of stocks relative to silver. Here is bubble 2. And so if we take the 2011 top at 25 ounces of silver per S&P 500 unit, we are at 162 now. We were at 25 then. Take that ratio, multiply it by 41, and you get $265 an ounce of silver if we reach the 2011 highs relative to the S&P 500. But let's go further still. And now here's where we take a quantum leap. The Dow Jones Industrial Adjusted Ounce 1980 target of $2,676 an ounce. Why is that? Well, if we look at the silver to Dow Jones Industrial ratio, remember the chart a few slides ago where we took the 2011 top. Now we're going to take the 1980 top. We're going to reverse the chart so we can see it better. The top of silver relative to the Dow Jones Industrial ratio was 57. This, of course, is the ratio times 1,000. Just to give it better, easier to do math numbers with. So if we take the ratio and multiply it by 1,000, we are at 0.873 now. We were at a high of 57 back in 1980. So if you take 57 divided by 0.873 multiplied by the current silver price of $41, you get a target of $2,676. Now let's move to the final target for silver. This is the S&P adjusted ounce 1980 target is $3,006. How is that? Because the ratio of silver to the S&P 500 index is now 0.006. You can see we've had an amazing rally in 2025. You can see a tiny little bump up. Look at that. It's amazing. What a rally. Silver is really tearing people's faces off. Is that the expression? Not really, not yet, but it will. But if we take this number and the peak here is at about 0.43, That's where the red line shows, maybe 0.44. I think it was actually 0.44. So if we take 0.44 divided by 0.006, multiply it by the current silver price of $41, we get $3,006 per ounce of silver. Now you could ask me, why do the silver to stocks ratios jump up so dramatically relative to all the other ratios? What is the deal here? I would say that 1980 was a true monetary panic. And in monetary panics, the top derivative layers of the pyramid fall the fastest, and all the purchasing power from those layers of the pyramid gets destroyed the fastest. If you have something like the CRB index, which is a collection of real commodities, or the gold to silver ratio, which gold will only go down to about 15-1. The Dow Jones and the S&P 500, by comparison, are a measure of derivatives, of things that are not money, that are farther away from money than, say, commodities are. And the CPI, for example, is the consumer price index, how much it costs to buy real commodities. And so those things are not going to fall in value because you need them relative to stocks, which you don't because they're just derivatives. And when derivatives fall because credit falls, their purchasing value goes down the fastest.
Let's walk through the 7 silver targets and what they actually mean for you. The first target is $118 per ounce, based on the CRB commodity index. In 1980, silver's ratio to a basket of commodities reached its most extreme, at just 8 ounces per CRB unit. If we return there, silver hits $118. That's the lowest floor. The minimum level history suggests is possible. The second target is $172 per ounce, adjusted for CPI inflation. But even Faber admits this one is weak because CPI is manipulated and doesn't reflect true purchasing power. Still, it shows that even the most conservative measure points to triple-digit silver. Next, the third target is $188, drawn from silver's 2011 ratio to the Dow Jones. Back then, it took 250 ounces of silver to buy one Dow unit. Today, it takes over 1,100. If that ratio snaps back, we land at $188. The fourth target is $236, tied to the natural 15-1 gold-silver ratio that reemerges in times of crisis. At today's gold price around $3,550, that ratio means silver should be near $236. This is the level where monetary history suggests the metals rebalance. But then it gets serious. The fifth target is $265 from silver's 2011 ratio to the S&P 500. That's when silver punched into its last major bull run. If stocks collapse relative to silver again, that's where we could go. And now, the quantum leap. The sixth target is $2,676. That comes from silver's relationship to the Dow Jones during the 1980 panic. Back then, silver hit a ratio of 57 ounces per Dow unit. If we repeat that against today's numbers, silver doesn't just break a few hundred, it breaks into the thousands. Finally, the seventh target, $3,036. This is based on silver's 1980 ratio against the S&P 500. It represents what happens when the entire stock market collapses against real money. And that's exactly what a monetary panic does. It destroys the top layers of the pyramid, stocks, bonds, derivatives, and forces all purchasing power into the base layers of real commodities and precious metals. The reason these higher targets matter is because they reveal the psychology of panic. People don't sell their food, their oil, or their land to rush into cash, but they will dump stocks, bonds, and credit instruments at any price. When everyone rushes for the exit at the same time, the purchasing power of those paper assets vanishes, and all that wealth tries to squeeze into the tiny doors of gold and silver. That's why the most explosive upside is not $100 or $200. It's thousands of dollars per ounce, just as we saw in 1980. And this time, the bubble of credit, debt, and derivatives is larger than anything in history.
So this time, I think we're going to get closer to the $3,000 targets that we saw hit in 1980 in the Dow Jones and the S&P 500, because it is the top derivative layers of the pyramid that will fall in purchasing power the fastest. And so all the purchasing power in those assets now, people look at their portfolios, they see a dollar amount, they imagine how much they can buy. And this is what I explained on the Endgame Investor on Substack, link in the description below if you want to read it. I recommend that you do. Is that imagine that everyone wants to get out of their stocks at the same time. What will be the purchasing power that they will be able to squeeze out of that sale? Well, any individual can probably liquidate their entire portfolio and get the current dollar amount that is shown on their dashboard on their brokerage. But if everyone sells at the same time, the dollar amount that they'll be able to sell for will be much, much lower, because when everyone's selling at the same time, the dollar price of all the stocks go down. And so the purchasing power that they think they have in their portfolios is not actually there. But in a world where credit doesn't work, the dollar doesn't buy anything, by definition, all of the purchasing power that is currently in the collective stock portfolios of everybody in the world goes into the most liquid commodities on the planet in an effort to reestablish the division of labor. And those commodities are, of course, gold and silver.
So, here's the real question. Are we heading into another 1980-style monetary panic, where silver doesn't just double but multiplies 10, 20, even 50 times? Or will central banks and governments find a way to keep the system alive just a little longer? I want to hear from you. Do you think silver peaks closer to $200, $500, $1,000, or $3,000 plus in the coming crisis? Drop your answer in the comments. Let's see where this community stands. And if you found this breakdown valuable, make sure to hit that like button, subscribe to the channel, and turn on notifications so you never miss the next update. The endgame isn't just theory anymore, it's unfolding in real time.